So that leads me right into, your main concern. We can get right into it. So I learned a lot about venture capital, man, a lot. I've been on many different sides of the table. First as a founder, such as yourself,
Right.
then as I ran an incubator. So after I sold my
Okay.
business, I started an incubator and I started helping companies kind of groom themselves to pitch investors. And,
Right.
so I went from across the VC to on the side of the VC because I wasn't directly a VC, but I was helping companies get there. So the closer you get into it, the more
Mm-hmm.
insider information you start kind of understanding. Then after a while, I ran an
Absolutely.
accelerator, which is almost just like an incubator, except you start funding the businesses yourself. So
Gotcha.
I was running a small fund, and the accelerator model is a little bit different because VCs will give you money and kind of let you go do your thing. Accelerators
Gotcha.
worked with really really young businesses, and we would give them 50,000, right?
Right.
And
Mm-hmm.
and then for a 3 month period, we were working with them just about every day, if not every day, full time
Okay.
days. So it's a very
Okay.
hands-on process. It's 90 days. You're in, you're out. You're in, you're out. And we gave them 50 grand, and we
Right.
bought 7% of the business, and then they would go and do their
Okay.
thing. After that, I graduated into venture capital. But the great thing is, I didn't enter it like an associate. I started. We went right to the top, and we became.
Right.
We started our own thing. We went out there. We had this vision, just much like you do, and did.
Mm-hmm.
And we were able to raise money for it, and we were targeting 25 million. We ended up at 40, so it was a successful run for us.
Yeah.
Um, and
That's
then
good.
then I was a proper VC. So I went from bump, 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 and then finally
Right.
all the way
Right.
around.
Right.
And I learned a
Right.
lot about VC. And there's a lot of things that people don't tell you in VC because of human nature. And what do I mean? Well, people have an
Okay.
inclination to they want to be liked. And
Right.
so a lot of VCs, they give, younger founders, I mean, young in their business, so new founders,
Right.
they'll give them the runaround, but they'll never be direct with the feedback that the
Gotcha.
business actually needs to hear because the VC is concerned about their reputation. They want to be liked. So they'll say, well, this is great. And then they'll create some fake milestone to say, oh, when you get here, we'll take a look at you. And then,
Right.
then the
Right.
founder's going on some wild goose hunt, and then it's just moving, they're just kicking the can down the road. So let me get
Gotcha.
into what actually, VCs look at. Okay. So in my mind, and we looked at, just to give you a sense, in 2018, we saw about 750 deals. In 2019, we saw 1,000 deals. So, I've
Okay.
looked at damn near between incubator, accelerator, and then those 2 years at the fund, plus the years that we invested as angels, I probably looked at 4,000 deals. So you
Really.
start getting a real good sense for what makes it, what doesn't.
What you look for?
So there's
Right.
two skill sets that you have to hone. And I don't think people make this distinction often enough.
Okay.
One is growing the business itself. Okay. So if you were running a small business or a franchise or, whatever, or a medium
Mm-hmm.
business, like that skill set is the only skill set that you need. Okay. Just running the
Right.
business, which for
Gotcha.
you, that's going to mean onboarding celebrities, blah, 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 figuring out the
Right.
payment loop, all
Absolutely.
that stuff. But then fundraising is the second skill set. And that's a skill set completely in and of itself. Right.
Right.
And the thing about venture capital, just so you understand the economics, is in private equity, right, which is what Warren Buffett does. When he buys a business, he buys the majority of the business. Okay.
Gotcha.
So like in private equity, you have one investor that comes in and you invest in the business and they buy 51%. And so that
Gotcha.
founder, that founder doesn't need to go and raise any more capital, right? So
Gotcha.
so the founder's ability to raise capital is not as important because they're buying a majority of the business anyway, right?
Right.
But now
Right.
notice, now I want you to note the big difference here, and that is in venture capital, you're not buying a majority, they're buying a minority, a very small
Gotcha.
piece of the business. Okay.
Right.
And when you do what's called a round, you raise your capital in rounds. Okay. So
Mm-hmm.
there's a seed
Absolutely.
round, their pre-seed round, the seed round, the A,
Right.
B, and it goes on. Right. So
Right.
when you do that, you usually have an investor, maximum an investor will take about 50% of your round. Okay.
Okay.
Usually you give up about 20% of your business in your first round.
Right. Okay.
Okay. So if an investor, do the math with me, if an investor is taking 50% of your round and you're giving up 20% of your business, 50% of 20% is 10%, right?
Right.
So they're on. And here's why I say this, right? So your biggest investor in your first round is really only buying. They're buying just 10% of your business.
10%.
Right. Okay, that means that you remember private equity they buy 51, VC they just buy 10, which means but you're raising 20 total. So that means you have another 10%.
You have another one. Right.
That is probably going to be split up between like a few smaller investors. Call it 4 or 5 more, right?
Right.
So now, because so much of venture capital is based on, because they're buying such small stakes, that means that they have to be comfortable and confident in your ability to raise money.
Right. Gotcha.
Because remember, private equity, they just buy the majority. You can sit back and chill. VC, it's about doing this. Because they know that even if they're the biggest check in, they're really only buying a little piece, which means in order for them to be successful and for them to get a return on their money, you need to still go out there and and just have that. Right. So people do not talk about this, right? Because they'll give you the metrics, and I could give you the metrics, it's all the same bullshit. Team, traction, market, you could Google that. So I'm not worried about that. But this is the stuff that they don't talk about. This is like there are certain soft skills and such that they're looking for in a founder that makes them confident, and for them to be able to say, this guy's gonna raise some money. He's gonna get it done. And so part of that, what does that mean? Well, it's not just having the material, right? It's also how you present the material, the way. It's not about the questions, it's not about the questions that they'll ask you, and it's not about the answer that you came up with. It's about they're assessing how you came up with the answer.
Gotcha.
You see the key difference? So they'll say, hey, well, what's the market size? And you can say, well, celebrity shout outs, are, let's say, I don't know, I'm making this up. Let's say $10 billion market a year, right? So you can have the info. But if you say, well, look, the market size, well, here's what Cameo's doing, and like based on that, if celebrity shout outs is about a $10 billion market. However, I'm only really aiming for that $2 billion piece that's done digitally every year, because that's the market size that I feel is the perfect place for us to start, because it's not too big, it's not too small, it's right in the middle. It gives us an opportunity to really generate substantial revenue, but stay focused in our messaging and our business.
Gotcha.
Then they'll be like, oh shit, okay. Right. Okay. You know what I'm saying?
I'm with you.
So every question that you'll be asked along the way is more so about how'd you get there? Okay, what the answer? Right. Okay, how'd you get there? So they're trying to understand your thought process as an entrepreneur,
right?
And they're trying to understand how it is that you are under pressure and so forth. But now let me also share this about VC. Okay, so in every other type of investment asset class, we call it, right? Real estate, bonds, hedge funds, whatever, stocks, private equity, small business, franchises, in every other type of investing, the investor gets paid out via distributions. Okay. Right. So they get paid out from the profits. Okay. So because in private equity and other types of securities, you can call them, they don't grow as fast. They're growing slow and steady. These are businesses that have a long history. You can look at their financials 10 years prior, and you know that every year they grow 5%, and you know that every quarter their profit is such and such. And so the investors invest, and then they expect a distribution quarterly. Venture capital is a completely different animal, because they're looking for businesses that not just do this, but go like this. Right. They're looking for businesses to grow.
Right.
And as a result, here's the key difference. As a result, they don't expect any distributions of profit.
Right.
None.
Fail.
Exactly. Why? Because they don't want to tap into the non-existent profits that the business has anyway. They expect you to just reinvest. And so remember, there's a common theme here. If you're reinvesting and you're raising a little bit of money, they know that you're probably not going to be profitable for a while because engineers are expensive and blah, blah, blah. And you need to float the money that Apple, all that stuff that you talked about.
Right.
So they know that you're probably going to need to raise another round. Right. And then another round. Right. Just like I'm looking at Cameo's. There's a website called Crunchbase.
Yeah, I'm always on Crunchbase.
Okay, cool.
Yeah.
So I'm looking at their Crunchbase, right? And they definitely, they have 65 million in, right?
Right.
They did, their first round might have been $1 million, and then they went from there and then went from there. So remember,
they went to 12 and 50, right?
The through line is, hey, we need this founder to be able to raise capital.
Keep raising capital.
And that skill set in venture is weird. It's weird, man. It's because it's weird because it is almost disconnected from real life.
Gotcha.
And if you feel weird about VC and the way it happens, that's because it is. Like
it's weird.
It's weird. It's weird. It's a weird business. It's the only business. It's really the only investment class. So you're not crazy when you're like, wait a second. It's the only investment class where you get rewarded for how much you raise, not necessarily how much you make.
Yeah, how much you make, right?
It's just raising, and there's a bunch of buzz and hype, and then if I can let you into behind the scenes, right? If I could peel the curtains back, a lot of investors, they'll prop their own investments up, So like if a big fund invests, then other people will invest just because they invested. And then further downstream, when they go raise their next round of capital, is usually another group of VCs, because you usually have VCs focus on stages. So, in the seed stage, there you have certain people. There are some businesses that have, several funds for the A, for the B, for the C round, and they're vertically integrated. But for the most part, you have funds like Harlem Capital only do seed right now. Then you have funds that only do the A, only do the B, and so on. So by the time you get to the A, a lot of what they do is just look at who invested in the round prior. Now, I don't want to discount them completely, because there are some smart VCs that will grill and say, okay, well, what did you do with the money that you raised? And, there are some smart discussions that you'll have. However, VC is mostly a follower sport.
Gotcha.
For sure.
I could see that.
You could see that, right?
It makes sense. Yeah, absolutely.
So what does that mean for you? Well, okay. Well, that means that, this game is really less about, how good you are on the business side. And it's equal, if not slightly greater, preference on, how good is this guy at raising money?
Right.
I need him to raise money. I need her to know how to raise money. You got to speak my fucking language. That's what VCs think all the time. Like, you got to speak my language.
Gotcha.
So that means me being you, I would invest a lot of time into getting up to par on the speed, on the lingo, on, some of the soft skills. That means practicing a lot. That means, really knowing the terminology cold, really knowing, you got to know your numbers cold. I'm surprised at the amount of founders that go raise that don't even know their own numbers cold. They don't have a chance.
Really?
If you don't know your numbers cold, you ain't got a chance. If you know your numbers cold, you got a little bit more of a chance, but that still don't really mean that, that you're in the door. And that's why your question that I get a lot is, hey, what's the criteria? So there are criteria that you have on paper, team, traction, market, but what I'm revealing to you are the things that I learned from doing it really, and seeing with my own eyes, like, wow, this founder has everything that we say we need.
Right.
But they're not getting funded. Why? Because we're not confident in their ability to raise more money, or whatever the case may be, so yeah, that's just an insider look, man. And so now, me being you, right? So now this is my advice for like where you are. So then, me being you, what does that mean? Well, look, the reality about businesses and products that get funded, this is the stark reality, is the businesses that get the most funding need it the least.
Right.
Because think about it. If, in the seed stage, or, I would put you in the pre-seed round personally, because it's less competitive, so you can get a little bit more money. So in the pre-seed round, or call it the seed round, seed is misleading because you think it's the first money in.
Right.
But at this point, venture capital has really matured. So seed is actually much later. The seed is the Series A of 5 years ago. You know, it's just everything's just getting bigger and bigger. So now if you go raise a seed round, let's say, because let's say we didn't have this conversation, and let's say, you know, you're like, all right, well, I'm going to go raise a seed round. Well, you're in that pool in the seed round. I could tell you that the majority of businesses in the seed round that are getting funded are making between 250K to $1 million in revenue already.
Yeah, right.
So then if you tell me, right? So if a business, remember, venture capital is super risky anyway, because you're just looking for an exit. So if you're already in a super risky asset class, and then someone comes in and they have, you know, no revenue and just a little bit of a mature product, a little bit of traction, it's not that it's not that you don't like the business. It's just that you also got someone who's got 500K revenue, and you're just like, well, you know, I'm just gonna put my money here. So here's what I would do if I were you. Okay, I would not go for a seed round right now. I would angle it as a pre-seed round. Okay. And what you need to do, remember, we talked about that buzz, how people will invest based on who else invested. So what you're going to need to do is spend a little bit of time doing the groundwork on getting the app kind of in use, right? Because you need to, what this is all about, remember, is just the power of narrative. Yo, this is working. This is, people are excited. We got a few people on the platform. Correct. We got people on the platform. We got people that are paying for it. You know, you don't need to have a whole lot, but you can't wait until someone cuts you a check to get your first few people on.
Absolutely not. Yeah, no, absolutely not.
Right.
The boat is moving.
Correct. That's right. Boom. So that's what it is. It's like, hey, this ship is boom. I love it. Because most people will be like, well, if I only had an investor. No, this ship is leaving with or without anyone.
Is moving. Like, regardless of what happens, this show is moving.
I love it.
Like, it's nothing stopping it. You know what I'm saying?
I love it. So, and then once you get a few first people on the platform and your first few digi greets going on, your greets, celeb greets, whatever you want to call them, then from there, what I want you to focus on are less sophisticated investors. So we call them angels, right?
Gotcha.
So I want you to focus on angels. Why? Because the reality about a fund is, you know, those, even though the VCs, you feel as a founder like they hold the power, in reality, their LPs have the power, because, you know, they have investors. So they're professionally managing money. Right.
Absolutely.
And, you know, they got to generate returns. And so they have a whole bunch of, you know, math and modeling around the types of returns they need. And so the type of growth they need is like crazy. Whereas for angels, it's just their own money. So the required rate of return for them is usually not even, you know, super modeled out in terms of the math. It's just like, yo, I fuck with this guy. Yeah, I believe in him.
Right.
That's really the barrier.
Absolutely. I know it. Absolutely.
You know,
absolutely.
So me being you, I would focus on getting some of those angel checks. Once you got a little bit of that traction, to me, what you need to do is create a little bit of narrative and buzz. So if you can get one of the celebs to invest, you know, if you can, you know, the type of person that you get is going to be more important than the type of money that they write, because the reality is angels are only really writing 25K checks, sometimes 10K, sometimes 50K.
Right.
But you know, you don't expect angels to write, you know, $1 million checks, because it's just not realistic.
Right. And it's not even needed at this point. Like,
right.
So
exactly.
I want to make, like, really, the money part is not the most important part right now. It's like you say, getting the celebrities on board, and I'm a partner with somebody in the industry, so they have the connections. The platform is already done. Like, we don't have a whole lot of bandwidth to pay for and all of that. So when it gets to that point, I have resources to say, okay, we're doing this amount. Yeah, it's going to be delayed 60 days. I might need 100,000 to do this. Boom. I have resources for that. So I'm just ready to start, you know, pushing to get the celebrities on board, and like partnering up with somebody who can make this easier, because I feel like it's going to be enough money when we sell to, I don't have to own 100%. Like, I'd rather own 40% of something that's making 100 million than 100% of something that's making nothing. And I'm on to the next one. Like, that's my whole mission, to build it, sell it, on to the next one. So
You got it. You're thinking about it 100% the right way, man. So that's my feedback on kind of where you're
I
at,
appreciate it.
and you're 100% on, like, you are thinking about it the same way I would be. So it's just that excitement is more important than anything. And then once you get some of that excitement, yo, listen, come on board, 25K. I'm not looking for you to be the squeeze here. I
Right.
just, just want your support on the cap table so that we're signaling to the market that this thing's exciting. Okay, bet 25, 25, 20. And I would personally,
Right.
after you have a little bit of traction, I would probably aim to get 150 to 250 in the door from just a number of angels.
Mm-hmm.
And that will be able to
Right.
fund you out and give you runway for 12, 18 months. And with that, you could probably
Right.
bring on an engineer in North Carolina that probably costs you 50, 75K, whatever.
75, right? Yeah,
Yep.
about 70. Yeah.
Yep. And then if you give them a little bit of equity, then you can maybe even get them for
Right.
60, right? So
Right.
now you have an in-house team. They can bring the product in-house, and you get some of that track. You can pay yourself a little bit if you want to leave the job, or you can continue doing the job and just be the CEO or whatever. And then from there, then you're really setting the stage to, if you do the right things, when you have the 150 to 250, you can really get to the point where you have enough traction that then you can go for the proper seed round, which is,
Gotcha.
and that's when you're going for the VC, the big boys. And that's
Right.
when, you can raise $1 million round. And remember what I said, your lead investor will take half. So you'll get a $500,000 check from one of them. And then probably
Right.
an angel group will invest as a syndicate for 150. You get another VC fund that
Right.
comes in for 250. And then you fill it out with some of your prior angels that want to reinvest, 20 at a time.
Gotcha.
And that's kind of how the round comes together. But the misleading thing is that, TechCrunch will really just report on the tip of the iceberg, but they don't really
Right. They don't dig deep into it, like who's all a part of this group and
so forth.
absolutely.
So I love it, man. I think you're in a good place. I'm excited for you to execute. And, I have no doubt you have good natural business acumen. So I'm not at all concerned about you being able to navigate what's coming. Just know it'll be hard, and just know that
Yeah.
I'm sure it's already been hard. But just know, I think you're 100% spot on. You'll want to probably bring someone on that can help you accelerate the speed of those
Absolutely.
even if it means giving something up. So
Oh yeah, and I don't have a problem with that for the right fit.
Exactly.
Know what I'm saying?
Exactly. So Godspeed to you, man. I want to, I want to leave my email open to you. I don't want to make it transactional. This is just an experiment. I didn't even know people would really get these. So it worked out great.
Like, $100. I just went to Walmart and spent $100.
Right. I figure a lot of people figure the same thing, so it worked out. But yeah, man, I want, hit me as you have questions along the way. I want to be, here for you.
I definitely will. Okay, I appreciate your time, John.
My guy.
All right, have a good one, man.
Peace.
All right, thank you. Later.